Welcome back to Beyond the Ledger, where we go beyond the numbers to unpack the strategies, risks, and opportunities shaping today's businesses. I'm your host, Shardae Layfield, and today we're pulling back the curtain on a topic at the intersection of transfer pricing, treasury, and tax controversy. I'm talking about intercompany financing. Whether you're a CFO thinking about liquidity and leverage, or a tax leader trying to stay ahead of audit risk, this conversation will help you approach intercompany financing with greater clarity, confidence, and control. Let's dive into the conversation. Joining today's conversation is Ben Miller, partner and leader of Bennett Thrasher's pricing practice, where he works with clients to design, implement, and maintain transfer pricing policies that align strategic business objectives with local and foreign transfer pricing rules and regulations. His industry experience is broad-based, with focuses in manufacturing and distribution, technology, professional services, and real estate. Thank you for being here.
Yeah, thanks for having me.
Thank you. Also joining us today is Abbas Raza. Welcome back. Senior Manager in Bennett Thrasher's tax practice, where he supports clients across a range of tax, accounting, and finance matters. He specializes in transfer pricing, providing benchmarking, cost allocations, intangible valuation, and economic modeling to help companies align with global regulations. So both of our guests regularly help companies navigate the complexities of intercompany debt, pricing, and global scrutiny. Together, we'll break down when an intercompany balance crosses the line into debt, what documentation actually holds up under audit, how to think about setting defensible interest rates, and where companies most often get tripped up, both in the U.S. and abroad. Ben and Abbas, you wanted to come on and talk about financing transactions. So what are those? Why should people care? Can you please share more?
Yeah, you're the person who's returning on the scene here today, Abbas. So why don't you kick it off and share a little bit about why we thought financing transactions would be good to talk about.
Yeah, so I think in the world of transfer pricing, financing transactions have taken kind of a backseat in the mind of practitioners and businesses. As most business owners will tell you, they care about the operating results of their business. And so, the licensing deals between the related parties, the sales of tangible goods, management services, those types of activities are really what's top of mind because that's what's helping drive the business to move forward. And financing transactions, they kind of come in as a backseat topic and haven't really received the scrutiny from tax authorities in the past either. Yeah. That's changing now. Me and Ben are now seeing that tax authorities have gotten a little bit wiser with how they approach reviewing financing transactions, and they've also published more guidance to both provide themselves with a basis for evaluating these transactions on a consistent basis, as well as providing taxpayers a little bit more direct, what do you call it, not instructions.
Yeah, but just sort of clarity, I think, on expectations.
Yeah, on expectations.
And Shardae, that's a big change, right? So if you kind of cycle back a decade, the IRS and other tax authorities were putting out a lot of information on services transactions, on how much profits distributors should be making when they buy and sell tangible goods. But in the past few years, the writing we're seeing out of the IRS, including their practice units, are focused on financing transactions. So generally loans, right? We're talking about where a company is providing financing or money, right? Some sort of capital to a company that might be set up here in the U.S. to explore the U.S. market, or it can be the other way around where you have a U.S. company that's providing financing to a related party abroad. But in either case, loans are the most common of what we see. But in addition to that, you may also see guarantees. And so that would be where you have an entity that goes to get a loan from a bank or to secure a supplier or vendor sort of arrangement. But the bank or the supplier says, I don't really know you, and not really sure about this, is anyone willing to sign off on your behalf, right? So I always think about it, some people are fortunate when they go to get their first car that someone's willing to put their name down, right, for that. So or whatever it might be. So it's that sort of idea. And so there's compensation due for that type of a financial guarantee, or there's even performance guarantees and others that we won't jump into today. But those are the two most common types of financing transactions. And what's really interesting, I think, about it is sort of, you don't always even know you have one when you're a business owner.
Yeah.
And so that's what I know. You said we'll talk about pitfalls a little bit later, but that's something we'll definitely want to discuss with you here as we're getting into this more.
I've got a quick question. When you guys, it takes more of a back seat, why do you think that is? I'm just curious.
Well, so one thing as Ben kind of alluded here is these types of transactions can occur just through the normal day-to-day business. If a balance is just kind of left out there, neither the business owner or the financial manager or CFO, what have you, they never had the intention to create that debt or create a loan. But because of how that balance has been treated just through the passage of time, tax authorities may ultimately look at that balance as a loan. Yeah.
So, quick example, right? A boss makes these really cool widgets and sells them to me to distribute. But we're brothers, right, obviously, and so we're related parties, right? So we have to support this under the 482 transfer pricing rules, right? So a boss, when you sell me the goods, right, next step is like, okay, I'm going to go out and sell them, but what if I don't get the money in real quickly from my customer?
Right.
How do I pay a boss? So let's say the first month I buy 100 and then another 100 and then another 100. But I don't know, servicing the healthcare industry in a government-run healthcare sector that doesn't pay for 3 years. Who knows? So in that sort of situation, would you just sell to anybody for not get paid for 3 years? You better say no, we're business partners, right? So it's that sort of an idea. So we may think we're doing normal business, but because of the market and because of the way the transactions are working, the tax authority would view it as a loan from a boss to me, because a boss is financing my ability to serve this customer in a kind of untimely way.
Right.
Yeah.
And so with that, you have to make interest payments. Yeah.
I just had to throw it in there because I was curious.
Yeah, so it does creep up in that. The other reason, though, I think it hasn't been as front of mind is because of the progression of just the industry in general. So transfer pricing is not new, but it's also a newer discipline within the accounting world globally. And so with that, the first and most direct issues have been tackled first, and then from there it's step by step. And we're now at the point where financing transactions, which are sort of the fourth leg of this chair, it's their turn. And so now it's their turn. So here we go, right?
Well, thank you. Okay. Let's start by drawing the line, because in payable versus debt, this is where many financing transactions quietly begin to drift into risk. So when does an intercompany balance start being a routine payable and start looking like true debt that should accrue interest?
So I think it is, based on the facts on a case-by-case basis. But, in transfer pricing, I always say, take a step back and look at how unrelated parties in your industry would handle the situation. So in certain industries, it may be very common to have a 30-day payable. In other industries, maybe it's 90 days.
Right.
But once you get past that kind of industry standard, that's when you need to start thinking about, am I kind of crossing a threshold here where unrelated parties would look at this and say, I'm not going to give you 2 years to pay me back for this inventory. I'll give you a loan.
Right.
And then so maybe you should start thinking about the way that you structured your intercompany transactions in a similar way, in that way. And so if you're not paying your balances, if the balances are just keep rolling over, and they're kind of necessary for the other party to continue to do its operations, similar to any other financing in another type of situation. That's when it's like, okay, well, the facts are kind of painting a picture where they're basically taking a loan to be able to finance their operations, not buying something and paying it back a month or two later, as most trade payables are usually settled.
Okay. So once that line starts to blur, the next question becomes what facts actually matter. So let's talk about facts that trigger recharacterization. What specific facts tend to tip auditors or tax authorities toward debt characterizations?
Yeah, so that's important, like very, very important question. So that one element of transfer pricing for loans is the interest rate. So is it 3%, 7%, 15%? Facts and circumstances, we can get to that. The second question, though, is what is the amount of the loan, right? So if we finance a distributor with, again, 100 or 100,000 or a million or whatever the number is, in third-party dealings, that is very rarely going to be all in the form of debt, right? So a company's balance sheet, to be able to go out and get a loan, often they need to have some equity or some other sort of assets on their balance sheet. So one of the ways that we can help companies a lot is by helping them to understand what we would call it their debt capacity, or how much debt they can take on their balance sheet given their operating model, their projections, their history, the economy and other factors. And so if you go beyond that, you are what's called thinly capitalized, and that's like, oh my goodness, thin capitalization, and tax authorities all over the world are attuned to it. They can very easily evaluate financials and tax returns to see what a company's capitalization is, debt to equity, right? And so what our goal is to help companies figure out what that line is so that they can sort of maximize the debt. Okay? If you get it wrong, it's one where we don't want to sail too close to the wind. No. It's not that then IRS comes in and recharacterizes it up to the line that would be appropriate. And the IRS has this sort of like, 1.5 to 1 should be okay, but there's no bright line. It's all based on legal precedent, and it can be very kind of complicated. But you go to all equity. So if they come in and sort of are able to show that it's too much debt on the balance sheet, right, and it doesn't align with the third-party dealing, you're done. And that's a huge issue and can make for very big problems for companies. Maybe, Abbas, I guess if you're the sort of guru in this, how does it sort of work to look at the debt capacity and what type of market data we're looking at for that? Probably be helpful for people to understand.
Yeah, so usually when we look at a debt capacity analysis, it's like a top-down approach. The first thing to look at is, what are unrelated parties usually carrying on their balance sheet in terms of their debt to equity ratios. And so that is one kind of data point to say, okay, industries in this, companies in this industry have, between 30 or 40% debt. And then it's also looking at the cash flow of our actual test case of the borrower in the situation is how much can they actually repay this debt? Do they have the capacity to repay this debt? Mm-hmm. Because a bank's not going to give you money if you can't repay it, right, or if there isn't some type of cash flow coming in that they can count on for the payments. And so that's something that would also be accounted for in determining what the debt capacity would be for a specific borrower. Yeah. Go ahead.
I was just saying, typically, like, we'll see if someone's pushing for a certain answer or wants something, they're going to miss it both on the leverage ratio and on the ability to repay, because it's just not really possible in the market, right? Yeah.
So, ready for the next one?
Yes.
Okay. Yeah. So if those facts points toward debt, the conversation naturally shifts to documentation that matters most. Mm-hmm. What documentation actually closes the gap between a simple intercompany payable and a bona fide loan?
Yeah, so again, thinking about this from an unrelated party perspective, I think everyone has some kind of experience getting a loan. And when you get that loan, that mortgage, what have you, you get a document, right? You get a document. And
you have to sign that document?
You have to sign the document. It's a legal document. Yeah. You don't pay the loan, there's consequences, right? Your car gets repossessed, the house goes into foreclosure. Bad things happen. And so I think that's how you should really think of this documentation.
Okay.
I think in the intercompany space and transfer pricing, you don't maybe need a 50-page bank loan document with all of that, but you do need to have a loan document that states the maturity date, the term of the loan, the interest rates, the payment terms.
Collateral
If they have anything there. If there's any co-borrowers or guarantors on the loan. However the company wishes to structure that loan, that should be in that document, and then it should be followed. I think Ben and I have seen many times where we ask for the loan document, they pull something out from like 1998 and say, here's the loan document, and they haven't followed it, and it doesn't even have all of the information there to, substantiate it as a loan.
No, I mean, we've seen them before. They come out and they're like, this says francs. They use euros now, and they have since I was in college. So, it's kind of an interesting situation. Sometimes it's very old.
Does that happen a lot?
It does happen a lot, either where it's old or where it's kind of maybe in an email, or maybe sort of, we talked about it, we're trying to do market. People, I think
or it's been changed. A new management team came in, they looked at the loan, and they're like, okay, let's just make the interest rate this amount. They send an email, and that's that. We come in 4 years later, and
there's a loan document from 2 years prior.
So
you're balancing some of these things. Most of the time it's well-intended and poorly implemented when it's not right.
Right.
When Bennett Thrasher's transfer pricing team helps,
it's always right.
It's always right.
Right.
That's what we're here for. It is tough. And then sort of behind this agreement that you would have, which is more or less a term sheet with signatures from each side, you would have this free cash flow analysis that Abbas was talking about that would show that the company does in fact have an ability to repay. Right? You would have some sort of benchmarking to show that the debt to equity ratio after taking on this additional debt is similar to other market players. And so again, it's something that's related to, or sort of relatable to the third party dealings in the market. And when you have sort of the term sheet and then the backup for it, then that's where we would say that you've definitely taken a good step forward, and you have a very strong first line of defense for a transfer pricing audit.
I was going to ask you what are a few things that they can do to get it right. So I'm glad you added that in there. All right. So building on that, let's make this tangible by focusing on top exhibits to defend the structure. If you had to name the top 2 or 3 exhibits that most consistently fend off recharacterization, which ones carry the most weight and why?
So, obviously the term sheet for the loan would be number 1. Number 2 would be the backup analysis and work papers showing how the credit rating was determined for the loan to determine the interest rate. The cash flow analysis to make sure that it's being able to be repaid. And then the last thing would be formal transfer pricing documentation in the format of the jurisdiction that they're operating in. And so in the U.S., that would be under Section 482. In most other countries, we look for OECD guidelines compliant transfer pricing documentation. So that would be the local file to master file for those multinationals.
Yeah, that's right. And that's sort of the bookend, right? So for us, it's sort of you plan, you document, you defend, right? So you do the planning to get it right. You document it in the format that's sort of expected by each local authority, and then if it comes up, we're there to defend it. Right. I think for me, the kind of neat part is that usually our documentation does the defense. For our clients, and that's good for everybody.
Yeah. Usually, if you're able to do the heavy lifting at the start of the transfer pricing exercise, everything downstream becomes much easier.
Yeah, and I guess it would probably be helpful just to add in, what's the difference between the advice we give to the company at the beginning of the year to tell them, here's how much debt you can take on and here's the interest rate, relative to that documentation at the end? What is the added piece for the...
Really, it's just the documentation substantiates that you actually followed your transfer pricing policy. So, like when you give the tax authority the loan agreement or the term sheet, they may be like, okay, well now did you follow this? When you see the documentation,
Right.
it's all there.
It shows that it was
that it's followed.
Right.
It's basically tested for compliance.
That's right.
And you get a big check mark from the tax authority, and we get a pat on the back for doing a good job.
And that's it, and it gives that rationale for why the approach was done to begin with, and that it was followed. Remember, we said, right, what's like one of the bigger issues for companies is that implementation and follow through. And so when you reach a certain size or when you operate in certain jurisdictions, the tax authority does not give you the option of whether or not you will represent that you have implemented properly. They require it
Right.
through these documents. And if you don't do it, there are penalties.
Right.
And they're real. And on a lot of tax returns around the world, even there'll be a little box that says, have you prepared your transfer pricing documentation? And so then if you didn't, I guess that's perjury or lying or one of those bad things. Anyways, that's why it's there. That's why the documentation is there. And
going back to the kind of recharacterization component, to the audience, debt has the tax benefits that taxpayers are looking for. And so one is the interest deduction. You want to get an interest rate that, I guess, optimizes the structure for
right.
it.
And that's helpful, right? So interest deductions are good. You reduce taxable income. Okay. And then the other piece of it is the debt, the amount of debt when you, the entity that receives the financing, when it pays back to the mothership.
Just a return of capital.
You repay debt as principal. When you repay equity, you have to pay withholding tax. It's a dividend. To the extent the company has earned money in the U.S. Or wherever it is. So it's far more tax efficient to have it be debt, both because you reduce your taxable income like year in, year out, and you reduce taxes when you repatriate money to where it came from.
And so when you hear this debt to equity recharacterization, that equity recharacterization is a big problem for our clients. So for any taxpayer, if that's not the intended structure, it is a huge headache when it kind of blows up.
Yeah, and just to expand on that, we've done plenty of deals for our clients that are $100, $200 million of debt. If that's all recharacterized and there's a 30% withholding, that's a
it's a big number.
Right.
So how much support do you want for the debt that you're taking on, that there is actually capacity to take it on, and how far do you want to push? As we don't like to sail very close to the wind in our practice. We like to have kind of middle of the road answers, but anyways, that's why it is such a big item, and it's full recharacterization. You lose all 100 of debt or all 200 or whatever it is. You don't just lose the difference between what IRS thinks it should have been and what you did.
Gotcha. Okay.
Even when documentation is in place, execution matters. So, which brings us to common operational missteps. Where do companies most often go wrong with short-term or operational intercompany balances that later become problematic?
You got answers. Let me hear them.
So I think, the answer that comes to mind is probably the most straightforward answer is time creates a small problem into a bigger problem. So if you have a balance that's $100 in year one, and then we're looking at it at year 10, and now it's a $10 million balance, what do you do with that? Because now that to get rid of that balance, it's going to cause cash issues. There might be tax consequences. Operationally, they don't want to move the cash. They're trying to expand this market, and they need that whatever cash they have in that market to stay there and not be sent over to the other jurisdiction. So time is a big killer here. It's much easier to handle it in year one, where there may not even be an issue, than when it's year 10, where a lot of facts have changed, the number has gotten much bigger, and the business needs of the company have evolved, where fixing something that has kind of happened in the last 5-10 years or what have you is not so easy as it once was. And that has caused, I think, a lot of different issues on how you want to treat it, how do we ultimately want to close out these balances, and there's a lot of different, I think, internal considerations and sometimes competing factions on how they want to kind of settle that out.
Like you got a story.
I just I was thinking of one that it's just sort of people kick the can down the road, right?
Yeah.
So it starts off as, this year we made X amount of product, we sent it to wherever, and it showed up and it was all moldy, or something happened.
Yeah.
And then they'll say, "Oh, all right, we'll just leave it. We'll be able to make the money back in the next years." And then something else happens, right? And hope's not a strategy, is it? So it's that. So we've seen that happen in different ways, and it can really, as Abbas is correctly saying, those problems grow over time.
Right.
And then to deal with them becomes very difficult, and they don't go away.
Thanks. Okay. I know. That's funny.
And once those missteps start to accumulate, we often see red flag auditors love. So, what red flags immediately catch attention, and how do those lead to imputed interest or dividend treatment?
Yeah, I mean, the IRS has a data analytics tool, and when you file a tax return, there are forms that show not only the financials of the U.S. company, but the financials of the affiliates globally.
Yeah.
And if you don't include those forms, the penalties are massive, tens of thousands of dollars per year per form, and there's not a lot of forgiveness for them. When you do include them, the IRS can look through them and quickly see, do you have loans, but you're not getting any, you've provided loans out, but you don't have any interest income. Is that happening somewhere or another? How thinly capitalized are each of the entities?
Right.
So they're able to go and do sort of back envelope calculations in a computer, and it flags the issues that everyone knows are there. So how do you avoid that? Is you provide advice that doesn't raise red flags. But that's the.
Simple as that.
But no, I mean, it's really about as simple as that.
Yeah.
And now that IRS has been more direct about saying that they expect certain, adherence to this, and it really has expanded in the past years. More scrutiny is being put on it, and I expect that to continue to grow. Right now, we're seeing it some at the tax authority level, and a lot in due diligence proceedings and those sorts of things, where there's a buyer and a seller, and they're saying, "Oh, well, you have this tax risk here related to recharacterization, and so we won't pay you as much money for your company, or we want you to, put some money in escrow in case the tax authority." This issue's coming up a lot now.
Right.
Yeah.
It used to come up some.
Now
It's like on the list every time.
yeah.
So, assuming a balance is clearly debt, the next critical step is pricing. So, let's dig into building an arm's length interest rate. So, walk us through how you build an arm's length interest rate in practice, and how do you reconcile parent versus subsidiary risk?
Yeah, so, the first thing to do is to get a credit rating for the borrower. And so that credit rating, we have different methodologies that we use to do that on our end. But mainly we rely on the tools and resources that the big rating agencies publish. And we have subscriptions for, so that'd be Standard & Poor's and Moody's. And basically we use the financial information and the business qualitative information for the borrower to construct a credit rating through that analysis. If a credit rating from a bank or some other type of information is not clearly there.
Our clients tend to not have third-party credit ratings.
Right.
Those cost, in the fractions, $1,000,000, $250,000, $500,000. They're tons of money, and they're usually for public companies.
Yeah.
Okay.
Most of our clients are not publicly traded, at least not in the U.S. And so we do these credit ratings. We call them synthetic credit ratings, right?
Okay.
And so that just helps us to understand, the credit worthiness of the company. Once we know that, we can reference market data to understand what sort of interest rate would be appropriate for
That type of credit rate, if that.
Yeah.
Okay.
Yeah.
Okay.
And then as it relates to like the parent subsidiary type of relationship, that's kind of an adjustment that we kind of look into. Once we do that synthetic credit rating from the financial qualitative data, then there are a few different types of adjustments, either the OECD guidelines or the US regs, or rather the IRS kind of provide guidance for doing, just to make sure that it aligns with what they kind of want to see. And so with parent and subsidiaries, the subsidiary, if it's the borrower in the group, one characteristic that we have to look into is if the borrower has group support from the parent and the rest of the group there. And so what that really means is it may not be correct to say that the borrower in a multinational group is acting by itself. Because if that borrower went to a bank, that bank would look at that entity, but also say, hey, you're also part of Microsoft, whatever. And
they would, right? And they might say, you're part of Microsoft, but you're this thing over here, you're some greenfield, experiment. If you don't work, Microsoft just toss you to the side. Versus you're Microsoft's largest X, or where they know you're super integrated, and Microsoft's going to come in and make sure you survive no matter what. Because so this parent-subsidiary relationship, it can go either way.
Yeah. It depends on the facts of the case. Yeah.
Okay.
What is the intention or purpose of this entity? What is the relationship with the group? And
And by the way, it can go the other direction too. So you can have a big company. Let's say you make. This came up yesterday in my house. I called something soda because I'm not from Atlanta, right? So here I know it's what kind of Coke are you going to have? I called it soda. It's a big issue. We had, it was a.
Well, you said pop.
Pop, then you're from like Ohio or Indiana, some Midwest. We don't do, none of us want pop. Okay, Shardae, get that out of here. But anyways, you might have a bunch of manufacturers, bottlers, things like that have operating income. They're making a lot of money, but the company as a group goes out and gets financing at the parent level. And so the subsidiaries sometimes, because of their operating cash flow, have stronger credit ratings than the parent itself. And so then you have like this subsidiary to parent support and subsidiary guarantees. You were saying before imputed this or that. There it's sort of an imputed guarantee, right? Because the subsidiaries are in fact providing the ability for the parent to get the loan. So when the parent gets that loan, is it fair for the parent to then kind of add margin before it loans out to the subsidiary? I think not, right? So maybe, I don't know, call us.
What's going on
but
here?
it's just sort of this level of complexity. When we talk about parent subsidiary, it's not like a straightforward, it's a blurred line and
it's dependent on the facts of the case, facts of the transaction. I would say for every kind of case that we look into this, it just varies depending on what the business has been doing over the lifetime of that debt.
Sounds like it'd be very complex, to say the least.
It's fun. We get to be like a bank.
Yeah, it is.
It's very
get to put on
exciting.
the bank hat and
Work is fun. Transfer pricing is exciting. It's engaging.
Yeah, you get to work in tangible goods. You're like a warehouse director. You're a banker when you're doing finance.
It's
you're
awesome.
IP attorney when you're doing licensing.
A lot of hats.
Of course. So that framework works best when data exists, which leads us to when comparables are thin. When external market comparables are limited, what's your playbook? Do you guys rely on internal banking lines or, group borrowing costs? What is that?
Yeah, so that's...
So we do look at like group borrowing costs, what the terms of any third-party financing the group may have gotten. That's definitely something that we look into when we start the analysis.
and just to think through that, we try to look at that at the same time that we do the independent benchmarking itself. And part of it's because of that sort of subsidiary parent subsidiary relationship we were just talking about, where if the group is at some level of an interest rating, it's hard to believe that a subsidiary would be so different if it's critical to the group's success. The group will always save it if something bad starts, that depending on all these factors. So we do like to look at the group borrowing costs. We do like to understand how they sort of access capital, right? We also like to, though, and have to, look at what the borrower or the receiver of the loan would get on the open market as a standalone company. Because that's part of the essence of transfer pricing, is to treat the entities as if they're standalone companies. So we do it sort of from both perspectives, and then we try to ensure that the outcome is realistic, both from the perspective of the borrower and the lender. And the only way to do that is by looking at both ends of it, sort of through the group lens.
And I will say we're lucky in the United States. We have very robust debt markets with lots of data that we can rely on. So typically we can find good comparables in the U.S. market. Outside the U.S. market is where there is maybe some lack of availability on market data that we can use. And that's when we have to maybe get a little creative or use the best available data at our disposal. To just get the best answer that we can with the information that we have. And so usually that's with, maybe smaller European countries where capital IQ or Standard & Poor's may not have most up-to-date data or very sparse data points.
Right.
And so we can use those data points, but we usually have to build up on it either by looking at neighboring countries or the region, like maybe Europe as a whole, and doing some adjustments there for the specific country that we're looking at.
And how do you defend adjustments like implicit support?
Defend? So that's usually going to be done in the memo that we would prepare that kind of documents our analysis, or in that end of year documentation that we had mentioned earlier. And it really will be just the facts of the case. And so if the implicit support is there, we would basically state that the parent company and the subsidiary kind of work in tandem. The parent company has a certain kind of stake in the benefits of the subsidiary, and so it's not going to let it just blow up, and so that it's basically just narrating a story. I will say in transfer pricing, a lot of the kind of communication of the analysis is about narrating a story that fits all of the pieces into into a narrative that makes sense from both, from a business perspective. Like, it's a business happening, this is what happened, this is what they're doing, these are the responsibilities of everyone, and we make a conclusion on whether that's appropriate or not.
Right. And it's not sort of ad hoc, so we'll use the similar methods as the rating agencies who also assess these sorts of relationships when they give those ratings to the public companies. So as we're doing it, we're using kind of these standard structures, standard procedures. We fit in all the client's facts and everything else a boss is talking about, and then we make a conclusion. And that's how they defend their implicit support. Once a company has that and they follow it, it's upon the tax authority to show that they were completely unreasonable in what they've done. And that is very uncommon. If a company thinks it through,
documents it,
works with someone who knows what they're doing, documents it, implements it.
They're acting in good faith.
So that uncertainty often pushes towards safe harbors. So let's unpack using the section 1482.2 safe haven.
Yes.
When is this safe haven interest rate actually available, and when do taxpayers most often misapply it?
Yeah, so the safe haven rates, or the safe harbor rates published by the IRS, is an option for, I guess, U.S. taxpayers to price intercompany loans. It publishes interest rates based on basically three categories, depending on the duration of the loan: short, mid, medium, and long. Those rates are published and on a monthly basis, and so a taxpayer can basically use those rates as the rates given by the IRS. So they're good to go if you qualify for the safe harbor.
Right.
And so that's where companies just need to make sure that the loan that they're trying to price under this 482-2 safe harbor or safe haven rates is that they qualify. So the loan has to be denominated in USD.
Right. And the company cannot be
engaged. It can't be a bank.
Right. So it can't be like their primary operating thing. And so using the applicable federal rate, it's typically going to provide for an interest rate that is lower than what the market rate would be.
Okay.
It's kind of giving you the very best credit rating out there. And so for a lot of companies, it makes really good sense. So if you're in the U.S. and you're trying to finance abroad and you know you need to put this loan in place, you get a low interest rate. It's kind of, and no analysis needed, and you know it's right. And on the other side of the loan, the tax authority there is like, fine, the difference between what we might expect and this would just reduce the income that's taxable in our jurisdiction.
Yeah.
So
They're not going to touch it.
So it works well in that direction.
Okay.
When it comes in the other direction, some jurisdictions, countries abroad will push back a little bit, right? And they'll be like, no, it should be higher. And that's sort of case by case, but it works really, really well when you have a US-based entity that is expanding globally, or a US-based entity that has expanded globally
Okay.
and has sent crates of stuff abroad and has not gotten paid for it yet. Because that's where we've crossed that line into it being from a trade receivable into being a trade receivable that requires interest because it's effectively a loan. And then you can use this same safe haven rate for that as well.
And how do you decide between safe haven and market benchmarking, excuse me?
Yeah, so it's really, I think, on a case-by-case basis,
Okay.
and it really just comes down to what interest rate makes the most sense for the transaction and for the business. And so, like Ben alluded to, these safe harbor rates are usually on the lower side, and so that's your lower end. And if you want to have a higher interest rate for whatever business or tax purpose, that's when you want to do the benchmarking for the market rates to see what that additional margin would be on that rate.
Gotcha.
Okay, to bring this full circle, let's zoom out with funding pitfalls and global pushback. What are the biggest hidden traps when financing transactions are poorly designed? Like, for example, debt to equity misalignments, FS mismatches. Give me a little bit more on that.
I want to just revisit what you were saying earlier, where little problems become big problems. And so what starts as a kind of innocent, know that, they need 100,000 euros today to pursue XYZ, just send it over as a loan. We already did that debt to equity thing when we first set up the company. And then you get into a habit, but all of a sudden you've been kind of extending, more and more money as just loans, and now your debt to equity ratio is lopsided.
Yeah.
And now you get audited because the IRS's data tools flag it.
Right.
What are you going to say? Nothing, it's done. So it's really, really critical that these sorts of issues are addressed.
Right.
And that they're addressed in the same way as the operating transactions, because they all matter and they should be looked at every year at a minimum.
Every year.
I think a lot of companies get tripped up when they don't follow their own kind of intended procedure for handling the loan. And so a case kind of comes to mind where this global company provides loans to all of their subsidiaries around the world, and they have a kind of headquarter policy where this money that they give is treated as kind of a one-year loan that's renewed in perpetuity. And because that's their intention of it being renewed on a one-year term, they have basically kept the same interest rate for the last 7 years. And so when we look at it, we are taking them as their facts. Right. This is a one-year loan, and it's going to be renewed at the next year. And so the interest rate is going to have to be recalculated. But they've kept the same interest rate for the last 5 years. And so, there's not much we can do to change the past. Right. And so that's when we go into it and we're looking at it, and a lot of, headache can be relieved and not ever come into fruition if they would have just kind of paid attention at the end of each year, refreshed the loans, which was their stated policy, and just kind of kept it going. But now that they've not done that, there's just a lot of headaches and kind of determining what the interest rate should have been. Is there any risks in the past? And the thing about interest rates are they really are dependent on the debt markets. You know, so the yield curves are changing. The Fed is changing its interest rate policies, and so when you look back from a 2 or 3 year period, the rates can be very different. You can have the exact same credit rating, the exact same everything, but in year 1 the rate's 4%, and in year 3 it's 8%. That's a huge difference, and that's the market reality. You know, as transfer pricing professionals, as much as we would like to be able to do it, we can't change the market reality. We have to use the market as
Oh,
it
come
is.
on, Abbas.
If we could change it, we'd be really good service providers.
We might continue to provide services. If I could do that, you know, sorry, friends, but I'd be fishing. Yeah.
And so I think that's one thing all taxpayers need to keep in mind, especially with financing transactions, is unlike other types of transactions, services, tangible goods, which are dependent on market conditions, there is some inherent commercial properties or characteristics that are also embedded in those transactions. In financing, it's less commercial and more market. Like what the market is showing you is the answer.
Right.
And it's not like the market now, it's the market for when the terms were determined for the loan. And so that kind of mismatch when you're looking at a problem in the present, but you should be looking at the data from 2 years ago, is something I think companies sometimes overlook until they maybe get a letter in the mail that says we're about to look at everything.
Or until they go to have a transaction.
They're about to have a transaction. The opposing parties look at it and say, hey, I think we may have a way to get a better deal here.
Probably. So, and how do foreign tax authorities typically react to U.S.-centric approaches like the safe haven?
So that's what Ben was alluding to earlier is there's two things here. One is the OECD guidelines, which most countries kind of adopt into their local regulation. It does have language that says the safe harbor, any type of safe harbor approach by other countries is recognized or should be recognized in another OECD country if it's not kind of hurting that country. And so that comes to Ben's second point, where because the rates that are published by the IRS under these safe harbor method is lower than what most, I think, market rates would be, because they're kind of giving you the benefit of the doubt as the highest rating for that borrower. And so the foreign jurisdiction is going to be usually pretty happy, because if they were to do their own analysis, they would generate usually a higher rate, and so that would lower the taxable income in that country, and the tax authority usually would just kind of leave that be. Let's just collect the free money that's here.
And when it does go in the other direction, then the other tax authority is faced with the decision of whether or not they want to make an issue out of it or not. And the way that tax authorities interact, they do think about that. And so they might be willing to say, you know what, you're not really providing taxpayers at a massive advantage, disadvantage through this safe haven rate that's provided through your regulations. So because the U.S. is a member of the OECD, we'll let it go. Some countries, and particularly those that aren't OECD members, might not do that. But that's case by case. It is more or less respected. And it's a really good tool in our toolkit.
Thank you.
Yes.
Thank you, Ben. Thank you, Abbas, for being on today. I enjoyed our conversation. This was actually really fun.
This was fun for us, so we look forward to hopefully getting back on the show here.
Thank you again. You guys enjoy your day.
You too.
Thank you.
That wraps up today's conversation on intercompany financing. And as you've heard, the real risk isn't just getting the rate wrong, but failing to think holistically about characterization, documentation, and how those decisions play out across jurisdictions. A big thank you to Ben and Abbas for sharing their insights and practical guidance on navigating debt versus equity, safe harbor considerations, and the red flags tax authorities are watching most closely. If you found this episode helpful, be sure to subscribe to Beyond the Ledger and follow us for more conversations with Bennett Thrasher advisors and industry leaders on the issues shaping today's business environment. And if intercompany funding, transfer pricing, or global tax strategy is on your radar, visit btcpa.net to continue the conversation. Thanks for listening, and we'll see you for the next conversation.